Welcome. Today we're diving into IAS 2, the international accounting standard that governs how inventories are measured and reported. Inventories are a crucial asset for many businesses, and understanding how to account for them properly ensures accurate financial statements. IAS 2 sets out the rules for determining what costs should be included in inventory, which costs should be excluded, and the formulas you can use to assign costs. Let's break down these concepts step by step, starting with what makes up the cost of inventory. Inventory cost isn't just the price you pay for goods. Under IAS 2, it includes all costs necessary to bring inventory to its present location and condition. This means you need to consider not only the purchase price but also other expenses directly tied to getting inventory ready for sale or use. Think of it as the total investment made to have those goods available in your warehouse, ready for customers or production. Start with purchase costs. These are the direct costs you incur when buying inventory. They include the purchase price, import duties, and non-refundable taxes. But that's not all. Transport and handling costs, as well as any other expenses directly attributable to acquiring the inventory, are also included. However, you must subtract any trade discounts or rebates you receive. The result is the net purchase cost that forms part of your inventory value. Next, we have conversion costs. These are the costs incurred to transform raw materials into finished goods. Conversion costs include direct labor, wages paid to workers directly involved in production, and a systematic allocation of both fixed and variable production overheads. Fixed overheads are costs that remain constant regardless of output, like factory rent, while variable overheads change with production volume, such as utilities. Together, these make up the total conversion cost added to inventory. Let's clarify the difference between fixed and variable production overheads. Fixed overheads like depreciation and factory rent don't change with production levels. Variable overheads such as electricity or indirect materials increase as you produce more. Both types must be allocated systematically to inventory, ensuring each unit carries a fair share of these costs. This allocation helps present a true picture of inventory value on the balance sheet. Not all costs related to inventory are included in its value. IAS 2 specifically excludes certain costs such as abnormal waste of materials or labor, storage costs not necessary for production, administrative overheads unrelated to production, and selling or distribution expenses. These costs are recognized as expenses in the period they are incurred, rather than being capitalized as part of inventory. This distinction ensures that only relevant costs are included in inventory valuation. Imagine a production line where a machine breaks down, causing a batch of materials to be wasted. This abnormal waste is not considered part of inventory cost. Instead, it's recorded as an expense in the period it happens. By excluding such abnormal losses, IAS 2 ensures that inventory values are not artificially inflated by inefficiencies or unexpected events in the production process. Storage costs can be tricky. If storage is necessary during the production process, say aging cheese in a warehouse, those costs are included in inventory. But if you're simply storing finished goods waiting to be sold, those costs are excluded and expensed as incurred. This distinction helps ensure that only production-related storage is capitalized, keeping inventory values accurate and relevant. Administrative overheads not related to production, like office salaries or general management expenses, are not included in inventory cost. Similarly, selling and distribution expenses, such as advertising or delivery to customers, are always expensed in the period incurred. This separation ensures that only costs directly tied to bringing inventory to its present condition are capitalized. Now let's talk about how costs are assigned to inventory. IAS 2 allows specific cost formulas to be used depending on the nature of the inventory. The main methods are FIFO, first in, first out, and weighted average cost. These methods help determine which costs are attached to inventory items when they are sold or remain on hand. Consistency is key. Once you choose a method for similar inventory, you must stick with it. Let's visualize FIFO, or first in, first out. Imagine a row of boxes in a warehouse. The first box placed on the shelf is the first one sold or used. This method assumes that the oldest inventory costs are recognized first in cost of goods sold, while the newest costs remain in ending inventory. FIFO is logical for perishable goods or items with a shelf life, ensuring inventory values reflect recent purchases. Now picture the weighted average cost method. Here, all inventory costs are pooled together and averaged. Each time you purchase new inventory, the average cost per unit is recalculated. When you sell or use inventory, you assign this average cost to the items. This method smooths out price fluctuations and is especially useful when inventory items are indistinguishable from each other. Specific identification method is used for unique or customized items that aren't interchangeable. For example, luxury cars or custom machinery. Each item's actual cost is tracked individually, so when it's sold, you know exactly which cost to assign. This method provides precise inventory valuation but is only practical when items are clearly distinguishable. IAS 2 prohibits the use of LIFO, or last in, first out. LIFO assumes the newest inventory is sold first, which can distort profit and inventory values, especially during inflation. Because LIFO may not reflect the actual flow of goods or provide reliable information, it's not permitted under IAS 2. This ensures consistency and comparability in financial reporting. Wrap up: IAS 2 ensures that inventory is valued accurately by including only relevant costs and applying consistent cost formulas. Remember, purchase and conversion costs are included, while abnormal waste, unrelated storage, and selling expenses are excluded. FIFO and weighted average are the main cost formulas allowed, with specific identification for unique items. LIFO is not permitted. Understanding these principles helps maintain transparency and reliability in your financial statements.